Hello and welcome back to Passive Aggressive Money. So, gonna shrink down over here. And chances are you can't read this, but there are also notes to make sure that I don't miss anything. But I can have this available to anyone that asks. So just let me know if you want this mind map that I created. Let's go over to a whiteboard. So, here we are. Now, might have mentioned that I like to buy long term. There's a lot of advantages to this. So, today is April 2021, and starting off when I first set up an entry, at least when I'm starting my entry, I like to buy as far out into the future as I can, usually to the 2 Januaries from the current date. One advantage that might come to mind is that if it's 2 Januaries, that means it's over a year from now, meaning that if I was to actualize gains from that, that's going to be long-term capital gains tax versus short-term. So that's one way to think about it. Again, not financial advice. Talk to your tax person, blah, blah, blah. But anyways, so this is today. And this is a timeline going out into the future. Okay? And this is like, let's say, January 2023. Okay? And this is the price of the stock. Tick, 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 tick. A lot of people suggest trading around this range, which is the 3 to 6 month range. And if you're a regular trader and you do that, there's advantages to that. I roughly agree to the 3 to 6 month range as well. But in this case, I'm going to buy out here. And the reason being that this is why I love highly volatile stocks and funds when I'm trading options against them. Because like I said, if you're just holding the stock or the fund, might be a form of gambling if you're thinking of doing anything short term with that. So you want it to, you expect it to be what it is, and do what it's going to do, but you buy the time to take the best advantage from that, right? So let's say this starts moving up and down violently. Just, crazy over here. That's a spike in volatility, right? Because if it naturally starts to move in one way or another, it inflates the prices. Because if you think about what an option is, you're buying a contract to buy it at a certain day at a certain price. So if you give yourself more time, and the waters have been somewhat still comparatively, and it makes a huge move in one direction or the other, the potential of it within this short term right here is, let's say, this wave up here of just like a ripple effect into the future of, there's going to be price inflation and things are going to spike up and down within this range right here. But if we own something that's out all the way into the future, think about the ripple effect that creates, right? Because if you think about it intuitively, we're saying that, crap, this made a move, like 10% move just today. In one day it moved and spiked up this much, right? Which you'd expect, but it's making this crazy move. Intuitively, you can say, project that out and give it an entire year plus. What does it do to its potential price? So it creates this ripple out into the future where if you were buying it over here for this price, then if its range was like going to be like, hey, it's going to be around this range right here, when it makes its big, spike of volatility, that's going to be like, well, I don't know, it's going to be anywhere here. It's going to just completely just inflate the cost of that. That's what happened with, say, Tesla, right? If you had calls that were expiring way on into the future and then it started making those crazy rides up, they just kept going up and up and up. But like within those specific moments in time where they were really, really high up, that spike in volatility and its expected volatility just inflated the price of those long positions. Sorry. Like I said, I had to re-record this, so add another layer there. We're back over here. So, okay. So I'm gonna do something, or I'm gonna suggest something that's also a taboo to a lot of options traders, which is I'm gonna strictly buy and sell out of the money options. And there's a reason why this is a taboo. And I agree with it, but there's a cost benefit to everything. And personally, especially when it comes to these highly volatile things we're trading, I'd rather lose 100% of my money in a smaller amount of something than 40% of something in a much larger amount. Because that smaller amount we lost everything in, we still had a bunch of gunpowder on the side where we can just start using that for something else, or to double down if it doesn't go in our direction or something like that. But if we have a bunch of capital deployed and we lose a big chunk of that, well, that's an opportunity cost right there, right? So I'm going to assume you know what a call and a put is and what out of the money means. If you don't, look it up. And I'm going to draw things out slightly differently than I did in the timeline earlier, which is to draw things out in the map that is commonly known as the risk analysis map. So XY axis. Okay, instead of up and down being the price of the stock, up and down is actually our profitability. So everything down here means we're losing money, and everything up here means we're gaining money. And as you might guess, to the right means we're making the stock is going up in price, and down this way, to the left, it means that the stock's going down in price. So, if we draw out a line map of what our profitability would be based on what happens to the price of the stock, this is the shape we want to create. Okay? So, what you might be thinking is, okay, well, if a market is, we trade one thing for another, how is it possible that we can make gains whether it goes in either direction? The reason for that is the cost you're paying is that this, if you imagine the U, every day is going to slightly tick down. So the longer it does nothing, the more it costs you. Which is also why I buy so far out into the future. And there's intuitive reasons for this. So, if you imagine 3 to 1 months from now or a week from now, an option set to expire, how much quickly, if it's out of the money, is that going to accelerate to zero? The answer would be faster and faster and faster as it gets closer to the expiration. And so, just to rewind that, if that went over your head, options have an expiration date, right? So if it expires sooner rather than later, that means that it's turning less and less speculative and more actualized. As in, whether or not the stock price crosses it is going to be a more and more bigger deal versus out into the future. So, if we have it expiring in over a year, naturally, the value that it, or the speed at which it decreases its value over time is not going to be very quick. So even right there in us choosing as neutral of a position of entry, our actual cost there in there's a give and take of everything, and the actual give of it, I'm even making it so it's not going to reduce quite as quickly as if I was to buy it earlier in expiration. Now the cost of that again is also, if you buy out into the future, things get more expensive. Also, you have to be patient. People aren't very patient, and so that creates an opportunity if you're willing to be. So, again, like I said, this is taboo. A lot of people will argue to not listen to me here, but I've been somewhat successful with this. So, again, numbers are arbitrary. What I'm trying to do is I'm very visual, so I'm trying to create this shape. So, it might be one option or multiple options in spreads. I adjust to just create this shape, and that's all I want. So this is calls that I've bought, calls that I've sold, puts that I've bought, puts that I've sold. So if you're used to using Thinkorswim, you can simulate trades, so you can add and remove different positions and see what it would do to your risk reward before you submit the trade. So, I'm not saying 10, 10, 10, 10. I'm not saying 5, 5. One of them might be more expensive than the other, so you might have to buy more of one than the other to create a more symmetrical risk reward. Or you might be more biased towards it being towards the upside versus the downside, so you might want to, instead of it being symmetrical, slightly curve in the direction that you would want. This is brainstorming. Adjust the recipe to your taste, right? So this is how we created the scenario. So, because if you visualize the timeline that I drew out earlier, where volatility spikes will inflate the cost of buying the option out into the future, especially out way into the future. The same way, you get a benefit from selling at an inflated cost out into the future. So, how do we know if we got a good price on the buy or we got a good price on the sell? We don't know. But that's why we basically put our foot in a door where our entry is neutral. But then eventually something's going to happen. And that's going to make it so as the price is kind of finding itself of what's an actual fair valuation, what does the market decide this is worth, then one side wins out. And then that's when we make our adjustment. So we enter neutral, but when we, I don't want to say exit, but I would say adjust, then we adjust in a way that favors us way more than it makes us potentially vulnerable to risk in the downside. So now that we have this shape, in the next video I will talk about what could happen and what to do in those situations. And if you're liking this stuff, give it a like, follow. I might not do many more of these, and I'm probably not going to have enough time to just create content. So if you actually have questions and specific things you would want me to cover, leave a comment, let me know. And yeah, feedback is appreciated. So this is sort of step one, enter neutrally. Thanks for watching.